Hello and welcome, I'm Suyash Maheshwari and you are watching Last Tick here on News9 where we break down the day's action on the Lal Street. And after a subdued Monday, Indian markets, they resumed their downward journey with headliners correcting by about 1%. Now Nifty today broke below 21,900 and remember, it had taken support at those levels, 21,900 to 21,920 mark in the past 4 sessions. So, and we have been talking about it for the last couple of days now. So, we also mentioned that if Nifty fails to defend that 21,900 mark, a 200 point, 150 point correction could be in the offing. And if you look at today's price action, we are essentially halfway there. So one needs to be mindful of that. I mean, there could be another, 7,500 point sell off from these levels as well. On the upside, since we have broken below 21,900, now that becomes a resistance zone. But I think more importantly, it will be the 20-day moving average placed at around 21,976 because that is the level, we had that also coincided, by the way, with today's high. So there is some precedent over there. And the second point is that this is the first break below the 20 DMA in almost 2 months. So 20 DMA at 21,976, look out for that for critical resistance levels. But moving on to the broader markets, they were staging some sort of a recovery after that midweek meltdown last week. But as we had pointed out, the bears are, they are not done just yet. Clearly both segments of the market, they ended with cuts of about 1%, over 1% in fact. Nifty mid cap index saw a cut of about 1.24% in today's trade, whereas the small cap index, that declined by about 1.2%. So even talking to a lot of these experts, the valuation discomfort is still over there, and one needs to be extremely picky when it comes to their selection because again, because of that valuation discomfort, we could see potential correction from here on. And that said, one thing that you need to be cautious of, if that there is a bounce back from here on, there is a recovery, it would be slow and volatile, and unlike the recovery that we had seen in the past, because remember, since September there'd be like in every month we'd see a one day sort of a shakeout in the mid cap and the small cap space where they would give up about 3 to 4%, but the recovery would be almost immediate and in no time the markets would get back to record levels. But that doesn't seem to be the case just yet. The voices about this correction in the broader markets, that's getting louder. So be careful of that. But joining us in the studio now is Mr. Sudeep Bandopadhyay, Group Chairman at IndiTrade Capital. Thank you, sir, for joining us here on News9. What's your view on markets, and do you agree with this analysis that 21,900, since of course you don't really talk about short-term market moves, but 21,900 was looking as a good support for the markets. We have broken below that. More correction in the offing, sir?
So, I think the way I look at it, tomorrow there is a very important US Fed policy. Of course, we will react day after tomorrow evening. More than what they do, I think the commentary around the announcement will be extremely important. If the commentary is dovish, and the market there in the US gets excited about the same, I think we will see a follow-on buying in India as well. So while we can talk about levels and whether they will hold or not, the reality may change on Thursday itself. That's point number one. Point number two, I think fundamentally, I believe nothing has changed in Indian markets. Structurally, nothing has changed in Indian markets. So I don't think it's a gloom and doom scenario. The market had been going up continuously for months, and some amount of correction was, I would say, par for the course. Valuation, as you were rightly mentioning, was looking stretched in a lot of cases, and bit of correction, I don't think is going to do a major damage to the overall trajectory, which I believe is definitely positive. Now, look at this. Government has been spending huge amount of money on, capital expenditure. Now, if that kind of capital expenditure, which the government is committed to making and are making, I think continues, capex, infrastructure, construction, this entire space is going to do well. And so would the related segments. The only challenge in Indian economy and market, if you have to say, has been the rural consumption and the overall consumption theme, that hasn't yet picked up the way one would have wanted it to. And that's one area which needs to be closely monitored.
All right, sir, but apart from, rural consumption that of course has been lagging, and it has been lagging for some time now, private expenditure, that's also not picking up. What do you think? Why do you think that's the case, sir?
Well, private capital expenditure, Suresh, when does it come? It comes when there is a consumption demand. Now, if there is no consumption demand or the consumption demand is not strong enough, private capex will not come. The private companies participating in road infrastructure, railways, defense, that's happening. But the pure play consumption pickup is not happening. And if that doesn't happen, private capex for consumption will definitely not happen. I think these are two very, very closely related themes.
All right, moving on. I mean, I also wanted to get your views on, TCS and that, of course, the share fell because apparently Tata Sons has offloaded some stake and quite a lot of stake, 2 crore worth of equities. I mean, Sudeep sir, why is Tata Sons selling stake in TCS? I mean, and that too at a discount. I mean, is it to avoid going public because, they currently have about 20,000 crores of debt on their book. If they want to be classified as a core investment company, in which case it can go, avoid going public by September 2025, they need to bring down their debt to less than 100 crore. I mean, this stake sale pretty much takes care of half of it. And another reason why I think that, this could be the case is because TCS just conducted a buyback and now the group is selling stake. Of course, I mean, they are not the same company. I mean, it's the same group nonetheless, right?
I think it's pretty much to do with the, the public listing and avoiding public listing. You're absolutely right to say that I think 20,000 crore is roughly the debt and they need to reduce it to a negligible level, 100 crore kind of level. To come out of this listing issue, and I'm reasonably sure they are working towards that, and I think this is probably a first step in that direction. There will be a few more transactions in some other group company or maybe even in TCS going forward to ensure that they bring down the debt below that to that 100 crore kind of levels. I think that's what the intention is. There is nothing more, I suppose, to read into this particular action of Tata Sons.
All right. So just to clarify, you expect them to sell stake in more companies, more listed peers at a discount?
Well, I don't know what they will do at this stage, Suresh. It's very difficult to guess. But they need to bring down the debt. Now, this takes care of roughly half of that requirement. So balance half. 9,000-10,000 has to come from somewhere, and that somewhere can be, if they are independently goes ahead and raises money, that is one option they have. Second is to reduce the debt. I think between the two they have to do, and if they have to reduce the debt by selling shares, they will again go back willy-nilly to probably TCS and maybe some of the other large listed companies where their shareholding is above 40%. That's my guess, but one will have to wait and watch.
All right, I'll give you a third option, sir. Tata Capital's listing, is that a possibility?
Yeah, of course, that's also a possibility. But I don't know if that was the intention, then they would have gone ahead and did what they did today, that is sell TCS shares at a discount. If the intention was to go ahead and do the listing of Tata Capital, I think they wouldn't have done what they did today.
All right, and I mean, why do you think they are avoiding, this listing in the first place? Because we have been long told that going public helps unlock value, helps simplify complex group structures. So why do you think, Tata Sons is skirting this?
Well, I think you have to understand that at some level, the group's affairs needs to remain private. All the companies are listed. Tata Capital independently can get listed at some day. But because of this regulation to list Tata Sons, probably that is will not serve their purpose. They have a lot of ventures which they seed through Tata Sons, whether it's the airline business, whether it's the semiconductor business, and there are many such businesses which are seeded through Tata Sons. And getting into the public domain for these issues probably is not in the right thing to do. That's what they feel, and they want to keep this company private.
All right, fair enough. But moving on, Paytm is another company able to retain customers for perhaps future ventures.
Well, I'm extremely wary of entire this issue, what's going on around Paytm, particularly in the market. I think to buy Paytm at this stage, expecting certain things to happen in future, I think is very, very unrealistic and a very, very aggressive bid. I will definitely advise investors not to do that. You're absolutely right. There is no revenue model attached to it, to the current scenario or current alternates which they are working out. In future, whether they will be able to retain those customers and use the customers for something else and generate value through those future endeavors, I really find it impossible to ascribe a value of that to the current Paytm share price. So, well, I think good luck to people who are doing it, but I would avoid it.
All right, avoid Paytm. That's the word from Mr. Sudeep. Sir, but before we let you go, the markets are super volatile, and all investors, I mean, especially the retail investors that have just started coming into the markets since COVID, they are looking for value. Where do you think is the value in this market?
Well, I talked about construction, infrastructure, I think that is where the value is. And a lot of large diversified conglomerates also are having value. So look at, I'll just give you a name also. Look at Larsen & Toubro, it's corrected also. But I don't see any reason for it to correct. I mean, surely the investors can find a lot of these interesting bets in sectors which probably didn't warrant a correction, but in support of the sentiment, they corrected.
All right, and what would be your advice to such retail investors? Because I mean, a correction like this, a 7-8% fall in a matter of weeks, that's bound to shake your conviction on stock markets. What would be your advice to retail investors at this point in time?
Well, absolutely, there is no need to panic. I think if you are in the market for long term, just stay put. If you have liquidity, please buy select stocks. As I mentioned, sectors which are not affected by lack of consumption or lack of something happening or not happening in the international market. Government of India is doing a large capex, and that capex will benefit infra construction in a big way. So focus on these areas and buy stocks of these areas. If you have money, don't buy everything at one shot. Buy slowly and take advantage of this fall.
All right, take advantage of this fall. Do not deploy your money everywhere. Be selective in your approach. Maybe look for construction, infra themes, because that could offer value, and that really ties up well with the India story. That's the word coming in from Mr. Sudeep Bandyopadhyay. Sir, great insights from you as always. Thank you for joining us here on News9. But that's all we have in this edition of Last Stick. Thank you for watching.
Start with the end in mind. You need to know where you want to reach. Every morning that we wake up, we are exercising our choice. The destiny is decided. The results are known that I'm going to win. Life of a goalkeeper is something which has always intrigued me. When you come into a stadium, this is the highest level of pressure. When I set out to do something, I decide in my mind that failure is not an option.
What you feel very strongly about, those are the stories to tell.
I have a mind which is absolutely restless.
Mind and body are entangled sensations.
That brings me back to golf. It's an amazing game.
This is not a perfect game. You only learn from them.
If you have a formula to a success, then you can replicate it.
I feel this is my first step. I'm starting now.
The winner is first born in the mind. I think, therefore I am. We are all about our mind.
This and more. Streaming on News9 Plus. Subscribe and get free vouchers.
and welcome. You are watching Business Plus here on News9 Live. I'm Krishna Kumar. Joining me in the studio is my friend and colleague Karthik Malhotra. And we begin with the big story that we've been tracking all day here. And that has got to do with a story that emerged all the way from the land of the rising sun, that is Japan. Japan, something historic that happened in Japan could impact interest rates across the world. That's right, Bank of Japan, for the first time in 17 years, moved the interest rate, the average interest rate of Japan, into positive territory. Bear in mind, for all these 17 years, the average interest rate in Japan, the Bank of Japan's interest rate was minus 0.1%. And today, that was moved from minus 0.1% to positive 0.1%, the first time in 2 decades. It's a very important development that could mean a lot for interest rates, not just in Japan, but also all across the world, anywhere from the US to India. But first up, take a look at this.
Japan's central bank ended 8 years of negative interest rates on Tuesday, bringing in a new era of monetary policy in the country. It's the first rate hike in 17 years, but the Bank of Japan is keeping rates around zero, moving cautiously amid the country's fragile economic recovery. Japan is aiming to shift away from a focus on reflating growth with decades of massive monetary stimulus, so the decision was widely expected. Tokyo's central bank is the last in the world to exit negative rates, ending a time where global policymakers used cheap money and unconventional monetary tools to try and prop up growth. The BOJ on Tuesday also scrapped a policy aimed at capping long-term interest rates around zero, known as yield curve control, though the bank said it will keep buying broadly the same amount of government bonds as before and ramp up purchases in case yields rise rapidly. A spike in bond yields would make funding Japan's huge public debt more expensive. The country's public debt is already twice the size of its GDP and the largest among advanced economies. Analysts say Tuesday's announcement will have a very small actual impact on the economy. The central bank is expected to keep monetary conditions loose, and no major hike in household mortgage rates or funding costs are expected. But an end to the world's last remaining provider of cheap funds could jolt global financial markets. After amassing overseas investments in search of yields, Japanese investors may now look to shift money back to their home country.